Tonight's Market Monitor is a true blue bull. He says he feels the average investor is just too bearish right now. He is Phil Orlando, the chief equity strategist at Federated Investors and manager of the Federated Global Allocation Funds. Philip, always good to see you.
Bill, thanks for having me back.
So what leads you to believe that the average investor is too bearish right now, and why do you think that is?
Well, if you just go back 3 weeks ago, the stock market was down 10% or so on October 15th. The VIX, the volatility index, had spiked up to 31. Treasury yields had spiked down to 1.86%. And stocks were trading at 14 times forward earnings. In our view, that was completely out of whack. And we thought that there were three catalysts that were going to play out over the next couple of weeks that would reverse that statistical cheapness. We thought third quarter corporate earnings would be better than expected. We thought the third quarter GDP growth would be better than expected. Okay. And we thought the Republicans would do a pretty good job in the election on Tuesday night. So we're 3 for 3 on that, and now stocks are 10% higher.
All right, and now you've got a couple of stocks for investors, Phil, that maybe will encourage them to become a little more bullish. Let's go down your list. At the top of your list, TJX companies. Tell us why you like this one, trading now at $64.
Sure. TJX is one of our favorite retail stocks, and we're expecting a pretty good Christmas. But this is a stock that typically doesn't do well during Christmas. Typically, it might actually trade off 2, 3, 4%. So we think the stock is worth $75 looking out over the next year. So the point is that if we do get a couple of percent trade off here in the next couple of months, that's a good stock to put away.
We have a couple in the transportation sector. I'm going to guess I know why, but I'm going to let you say it. One is rail. The other is the aerospace company Boeing. Why do you like Boeing right now?
Boeing has got a 5-year backlog, literally $500 billion with the 787. Now, the stock is weak because crude oil prices are down. They've dropped from $110 to $75 a barrel. I can assure you, Bill, that crude is not going to be at $75 a barrel forever. This plane is very fuel efficient. I think this stock will be back in the $150 neighborhood over the next year.
Okay, and tell us about CSX. That's another one of the transportation companies that you like.
So transportation, rails in general, are an economic play. As the U.S. economy continues to do well over the course of the next year, we think there'll be more volumes. We think transportation companies, particularly Chessie, will enjoy some movement on pricing. And if you look at Chessie's valuation compared to other major rails, it's a lot cheaper. So we think that combination will drive this stock up to the $40 neighborhood over the next year.
Two things, though. You don't think oil will remain at $75, meaning you think they're going to go higher. That wouldn't be good for CSX. And CSX, as other transportation companies, are already doing very well right now. Are we getting in at too high a price?
Well, it's really a function of what are the different items that a company like CSX moves across the country. Now, one of the things that they move is coal, for example. And coal movers have been under pressure over the course of the last year because of what's been going on in Washington. Well, as a result of Tuesday night's activity, we suspect that there will be less pressure on coal going forward, and then that pressure on the stock will likely lift.
All right, Phil Orlando of Federated Investors, always good to see you. Thanks for joining us tonight. You bet.